Hello and welcome back to Well Balanced, brought to you by Vector Wealth Management. Today we're talking about all-time highs, a topic that's been popping up in headlines, conversations, and yes, maybe even in your family group texts. Let's start with the markets. Despite a rocky and uncertain first half of the year with tariff discussion, interest rate debates, geopolitical tensions, and a few unexpected surprises, the U.S. stock market has powered ahead. As of this week, major U.S. stock indices like the S&P 500 and the Nasdaq are at or near all-time highs. Now, an all-time high in stock prices alone doesn't mean the market is due for a drop. Just like your car's odometer hitting 100,000 miles doesn't mean the car will stop working. Markets hitting new highs is a very normal part of long-term investing. This year, we hit an all-time high 7 times. Last year, we recorded 57 all-time highs. Now, for the year, the U.S. stock market is up about 7%. This advance was not without drama. At one point in April, the market would decline by nearly 20% from the previous high, then recovered a whopping 26% from its bottom. This strong rally included a record-setting single-day performance on April 9th. To pull out a favorite line, the market takes a bumpy road to the long-term average. Now let's pivot to another kind of all-time high, and this one feels a little less celebratory. The U.S. government recently passed Budget Reconciliation Law H.R. 1, also known as One Big Beautiful Bill. And with it, the debt ceiling was increased by $5 trillion, from $36 trillion to $41 trillion. Those are some big numbers, and it might be hard to wrap your mind around. To put this into perspective, in 1996, roughly 30 years ago, the entire debt ceiling was about $5 trillion. Let's break this down. The debt ceiling is like the credit limit on Uncle Sam's credit card. It doesn't authorize new spending, it just lets the government keep paying for obligations it's already committed to. Think of Social Security, interest on bonds, defense spending, and so on. Over time, the debt ceiling has been raised again and again. In fact, it's happened nearly 80 times since 1960. Why? Because the size of our economy and our commitments have grown. But what does it mean for the economy? Well, raising the debt ceiling avoids default, which is good. But as debt levels rise, so do concerns about future interest payments and the government's flexibility in responding to crises. It's like if you maxed out your credit card and then you keep increasing your limit. You might be able to keep spending, but the monthly minimums get bigger, and eventually your credit card company starts to worry. Importantly, markets tend to react more to debt sustainability than to the raw number. Think debt level and interest expense relative to GDP, or economic activity. As long as the U.S. economy continues to grow and we maintain our trust in our institutions, we expect the system to hold. Another all-time high worth talking about, one that's hitting a lot closer to home for many families. The gap between home prices and home affordability is near an all-time high. Not great news for new home buyers. Home values continue to rise in many parts of the country, while the cost of borrowing due to higher mortgage interest rates has pushed affordability to record lows. To put in perspective, home prices have been rising steadily for over a decade, with a larger increase during the pandemic when interest rates were at historic lows. But now, with mortgage rates hovering around 6.5% to 7%, double the rate from 5 years ago, the monthly cost of owning a home, even at the same price, has gone up dramatically. Over time, these affordability crunches tend to create pressure for change, either through falling rates, flattening prices, or shifts in housing policy and supply. But importantly, none of these solutions happen overnight. As always, the financial landscape is full of both opportunity and complexity. Staying informed, grounded, and having a financial plan, we believe, is the key to navigating what comes next. Until next time, thank you for tuning in. As always, if you have questions, please let us know.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment